All right, hello everybody. Welcome to Korean Atlanta Mentorship here with another clickbait video of paying off debt. And you probably saw the big thumbnail. This cannot be real. But don't worry, we have over 700 videos of us paying off debt the same way over and over again, so we'll just do it one more time for this video. And so what's the first step of paying off debt? Well, it's basically creating a budget because your budget is your debt attack plan. So you have your income here, you have your expenses, leftover checking and savings, and then we just create an expense breakdown. And what's important about this expense breakdown is that you have to list every single debt that you have as its own line item, and then you list the payment associated with, and then here at the very bottom, we just kind of clump together our personal expenses not tied to debt, so food, gas, insurance, and all the other good stuff. And then you see that's $1,800 a month for this person on average. And so, how is this column different from what we call the velocity debt payoff method? Well, even though we have the same income and the same expenses, let's go ahead and copy the income and the expenses, right? uh, we're going to be intentional about saving money. So, really, two things we're going to be intentional about. Number one, we're not going to save money, right? No money's to be saved. And what we're going to do is put our money into something called the line of credit. So, the second thing that we're going to do is make sure that all of our money goes into a line of credit, and then we pull out money from a line of credit when we need it. Okay, so that's what this whole thing means. Put your paycheck into the checking account, and then from the checking account goes the line of credit, and then you take your expenses from the line of credit, goes to the checking account, and then you pay for your expenses, right? And so we're going to assume we have access to a line of credit. So if you have no idea what a line of credit is and you're new to this world, basically all it is a financial tool where you could borrow money, pay it back, and use it over and over again. And then you might be thinking, wait a minute, isn't that a credit card? Yes, a credit card's a form of line of credit, but it's a little bit inflexible compared to your personal or home equity lines of credit. Because if I overpay a credit card, can I use that credit card to pay another credit card or a student loan or auto loan? No, you can't. So there's a little bit of inflexibility built into that product. But what we want is 100% flexibility. So if you have a personal home equity line of credit, well, basically go to bank's website, click a button, decide, you can move money in and out as much as you want, and there's really no problem, right? And that when you click that button on the bank's website, it's just literal cash that's into your checking account. Okay, and that's what we're going to do today, right? So what we're going to do is move some of our debt into a line of credit. Okay, so think of this as a fancier, easier to use credit card. Well, it's not really that fancy. It doesn't have rewards points or anything like that. And this is going to be what we call our main operating account, right? So the difference between the average American and what we call the velocity debt payoff method is that your main operating account is your checking and savings, right? So the final destination of your money is your checking and savings. Whereas here, final destination of money is a line of credit. The checking and savings is what I call a temporary bus stop, right? Temporary bus stop. You just park it a little bit there, and then once you're moving, you can move into line of credit, then just move it immediately as soon as possible into line of credit. Okay. Now, quick question: if you're new to the world of banking, finance, and all the other good stuff, will the bank give you a free and clear line of credit, like $60,000 at 8%, if you have all this debt? Right, you have, let's say, four credit cards, an auto loan, student loan, and a mortgage. Will they do that for you? The answer to that is probably not, because banks don't lend money to people who need it, right? People who need money are bad people according to the bank, right? And you might be thinking, wait a minute, that doesn't make sense, right? And it makes sense from the perspective that the bank is either a vampire or a leech, okay? So if a vampire sees that your life force, aka your income, is being drained by other banks and lenders, and they'll be like, well, where's the blood for me to suck, right? There's no life force for me to suck. So I cannot accept this client for my banking services. Okay, that's what the bank is literally thinking. Another thing the bank also thinks is that, hey, people who need money, we just know that they don't pay people back, right? And that's because the bank does a gajillion transactions per year, right? They have all the data points. They pay money to report to credit bureaus because that information is so valuable. Because what do credit bureaus really track of? Who makes their payments? Okay, and the ultimate sin to a bank is if you're 90 days late on a payment. Like, being 90 days late on a payment is like, no, we don't want anything to do with you anymore. Okay. And they know that people who need money will be 90 days late, like almost 100% guaranteed. That's why they try to cut you off at that moment of the application when they sense that you need money, because they don't want you to go to underwriting because underwriting is expensive. Okay, so now why do we demonstrate with the free and clear line of credit? I'll tell you why we demonstrate with a free and clear line of credit, because it's easy to demonstrate. You want to see a more realistic scenarios of 22 debts, $4 left over, and a maxed out line of credit? That's what the 99-cent paywall is for. Okay, but we're going to demonstrate with the free and clear line of credit. So what we're going to do is with the cash flow index, and if you don't know what that is, just a basic formula of the balance of the debt divided by the monthly payment. Okay, and then you just do that for all your debts, and then think of this as a sorting or debt ranking system, right? I want to pay the low ones first because the low ones give me more bang for my buck in terms of cash flow. They give me more bang for my buck. And so here with this high number, okay, the high number, why do we not want to pay the high number first? Because we have to pay big amount of money for itty bitty cash flow, right? So think about this. We pay these two credit cards, which I think is 42,000. Is it 42,000? I think it is. We'll get more cash flow than the mortgage, which is 235,000. You got to think of ratios. You got to think of bang for your buck. Now, someone talked about this thing called a pill method to me, where you pay the mortgage first, and I'm like, I don't know, because you're gonna spend a lot of time, trying to chase this 235,000 when you have all this other credit card debt cooking at like 27 to 30% interest, right? So I would rather pay this off first, and then use that to pay the other debts off, and then so on and so forth. Okay, so let me just go here. So what we're going to do is, how much credit card debt do we have? 5, 8, 15, 27. Take the low cash flow index numbers first. That's 55,000, and I just made it convenient that the line of credit limit is 60,000, but that's to make the demonstration easy. So 55,000, right? And then this is going to be 0, 0, 0, 0, and then look at this. This is 440, literally 440 checking and savings, and $2,218.33 of cash flow. Okay, and you see that we have the same income just by shifting over some debt. And so when you see that, that's where kind of like the what the F moment comes, how this can't be real. Okay, like, whoa, how do we go from 440 to $2,218.33? I don't know. Okay, must be a scam. According to some people on the YouTubes, this is a scam. So, anyways, all right. So now you put your entire paycheck, $6,000, into the line of credit, take your expenses out, and then after every single month, the balance of the line of credit goes down about 2,000 some change. And I'll show you how to calculate this or approximate the calculation. So to get the next month's balance is based on the previous month's balance, previous month's interest minus whatever the cash flow is, so 2218.33. And then what we do is we take the average daily balance, right? Let me get the average number here. Whoopsie. Average daily balance. Multiply it by the interest rate. And then divide by 12, right? And so we see that we got to pay some interest for using the line of credit. But have no fear, because we will eventually get rid of that credit card debt. And let's go ahead and do this. And I'm going to go ahead and copy and paste. And then now we see that in 28 months, it's completely paid off. Okay. So let me just kind of go here, 28 months, and then 55K. And then I'm just going to go ahead and copy and paste, and then auto loan, student loan, and the mortgage. And luckily we have this loan calculator right here that I've developed with native Microsoft Excel functions. Look at all this. Look at how the payment amount, like, this is really confusing. Negative payment, C2 over D12, D12 times 12 B2. Like, it's really confusing. Okay. But luckily we have this financial calculator. I should just sell this for like 99 cents. Like, you want the loan calculator, you got to pay me. Okay. Or you create your own. You know what I'm saying? All right. So now this is what we're going to do. And then it's just like 30, 68, 195. And just follow the cash flow index. And this one's the auto loan, right? So this is the first one's the auto loan, 12 grand. I'm going to go ahead and do that. And then I'm going to move it into the line of credit. And we're going to do something and blah, blah, blah. Line of credit. All right. So now we move the auto loan into the line of credit. So 12142.61, right? And then what happens here, this is going to be $395.31. And so now our cash flow has increased to $2,613.34. Okay. And so now what we do is we update these numbers, and let's see if we get a month or two, probably just a month debt, a 1 month advance debt payoff, but 2613.64. Let's see if that does happen. Ooh, it did, right? So 32 months. Okay, that's really good. All right. So now we're just going to do this 32 months. And then this is going to be 55 plus 70, 22 is 77K. And then it's going to be student loan and the mortgage. And so now we just see that in 32 months. This would be 0, 31, 23, and then now what we just do is move the student loan into the line of credit. Now, here's the thing. Would I always move the student loan entirety into the line of credit? No. 7% student loan is close enough to the 8%. I'll be fine given our current budget, but got to be a little bit careful about amortized loans. And you might hear on the internet, amortized loans always bad. Always replace line of credit with loan, and I'll say that's not true, right? Like, you got to be a little bit careful and do some common sense, but sometimes that's a little bit missing these days. All right, so $3,000 of cash flow. So let's go ahead and do this, and I'm gonna go ahead and copy and paste, and then now we'll replace this with 3078.07, and I'm gonna go ahead and copy and paste, and then we'll blam. 43 months our student loan is paid off, right? So it's not bad that the only interest is about a couple $100 at most. Actually, only $201 at most. And then as we're going down, down, down to 43 months, and then we have it paid off, right? So 77 plus 40, whoopsie, 77 plus 40, that's 117K. All right. And then this is going to be 235,000, so this would be 43 months, 43. So it's 219,000. Now, we have to be careful about the 30-year mortgage, right? Because we take a look at this cash flow index. What does this high cash flow index mean? It means you have a little bit of money that you have to pay per month for big balance, right? Big money split into many little payments over time. That's what this high cash flow index means, right? And so the payment amount is really only affected by three things: original balance, interest rate, and terms. So if you have a really long term and a low interest rate, right, and you decide to move that big balance into a 30, I'm sorry, not a 30-year mortgage, of a 30-year mortgage into, let's say, a first lien HELOC, right, into a line of credit that's like 8%, you're going to end up paying more than you have to. Okay, so really you have two options here. You can just do extra payments, which is the default option, and I say, listen, if all you got is a 30-year mortgage, you want to do extra payments, that's perfectly fine. Okay, but think about how we got from here to here. One of the biggest principles that we adhere to, because there are certain principles that we should follow, kind of like, wearing a seatbelt. Even if you have a perfect driving record, right? You don't say, well, I have a perfect driving record, so I don't need to wear a seatbelt. You should still wear a seatbelt. And if you're doing dangerous activities like jumping off a cliff, maybe wear a helmet. That's a bad example, but you get my point. So here's the thing. How do we get from here to here? Well, one of the principles that we followed is to make sure that our money is in one place, right? And because the reason why we were broke is that the way that the banks make money is minimum payments on everything. We call this principle segregation of income, meaning your checking comes in, or your payment comes into your checking account, or your paycheck, I'm sorry. Then it gets split all over the place, and then you leave the leftover in checking and savings. So what we're trying to do here to prevent that is that you're putting all of your money in one place, aka the line of credit, so that you're always attacking debt, right? And you're not having your paycheck split all over the place. Now, you might be saying, like, if this is the last debt, then it's unlikely for that to happen. And that is true, right? So that's why I make the analogy like, hey, even if you have a perfect driving record, maybe you still want to put that seat belt. And I kind of consider like the line of credit as your seatbelt. But if you don't, that's perfectly fine as well, because there are plenty of people, I'm sure, who don't drive with seatbelts and don't get in crashes. Okay? Now, back to my point here is that you can do extra payments, which is the default option, but you have to kind of think about, well, if everybody knows that they can do extra payments, why don't they do it? That's like the question of the day, right? And that's because a loan is a one-way street that provides inconvenience if you try to overpay it directly, right? And so what happens here is like you overpaid the loan directly, and let's say like you paid way too much. Like you had some emergency expenses. Okay, use your credit card and your line of credit as backup, and then what happens? Income becomes segregated again, and you might kind of drift off to here. And if you listen to Dave Ramsey, he says that finance or personal finance, most of it's just behavior, right? And so what we could do to just kind of keep this philosophy of putting all our money into one place is by simply, okay, just using a line of credit but in small pieces. All right. So let's say we have this $235,000 loan, okay, and then we just move $6,000 into the line of credit. So let me just show you right here. I just say plus 6000, and then bam, bam, look, that 6 grand got wiped out in about 2 months. Okay, got wiped out. Look at that. I did this from a previous demonstration, which is why it's here. And so that's another way that you can do it. And if you take a look at the interest costs of a line of credit, whoop-de-doo, $20 a month, right? Maybe that's what they'll charge in the future when they make seatbelts into a subscription service, kind of like BMW is doing with with heating. I think heating the car or the car seats. I heard BMW is the ultimate luxury service by charging you for things that no sane person back 5-10 years ago would have paid for. But anyways, all right, so we do that at the mortgage. And so one of the things that I want to show you is that, hey, even though this is a higher interest rate, right, because the loan is at a 4, line of credit's at an 8, do you really have to be afraid of this? Okay, and then you show you right here that, hey, with all the information given at 8%, you'll pay it off in 5.2 years. And then this is 24 grand of interest that you pay in total, including the line of credit interest and the loan, as if you're just in, but if you're just making the minimum payment, okay, the minimum payment, then you wouldn't, this is what you would have paid, right? Now, if you really want to see what you would have paid, like with a higher interest rate, like, so let's say we do 15, so it's like almost double, you pay 2 grand more, right? So this is why it's like, oh, like this is kind of mind blowing that, okay, if I have enough cash flow, yes, I might have a variable interest rate, but you ever read all those articles about like if your loan has a variable interest rate, then it might be the end of the world. Well, if you know what you're doing, then the variable interest rate, yes, it does matter, but it kind of doesn't, right? It's just a little fluctuation that, you know, may may affect you slightly, but it's kind of like if you make $1 million and someone takes like a penny or two off of you, right? But it's not going to matter. And you ever hear that joke where like Bill Gates or Elon Musk, if they picked up a penny on the street, they'd actually be losing money. You know what I mean? Kind of like that, but not really. All right, so now if I do 30%, look at that. It's just 4 grand more. Okay. Now let me just show you something that will probably blow your mind because a lot of people advocate for this. If you move the entire loan into the line of credit, look at that. That literally doubled and it was more than the 30% line of credit, doing the small sweeps or chunks of moving it into the line of credit and just rinse and repeating over and over again. Yeah, you see that? This is why moving your entire 30-year mortgage into a line of credit is very how shall I say, is dangerous the right word? Anyways, all right, so let me just kind of go back here and then we'll just do $6,000. 24 grand, 5.2 years. All right, so let me go ahead and record that. Zero, this would be 43 divided by 12 plus 5.2, and then that's going to be 8.78 years, and then we're debt free. Okay. So, well, that's it for today, folks. This is Crane Lanta Mentorship here with another video. Don't forget to join my cult and subscribe. Have a great day. And why do I call it cult? A cult? Because if I can convince you to use an 8% or even a 15 or 30% line of credit against a 4% loan, you've joined my cult. Completely irrational. Okay. All right. Well, have a great day, and I'll see you on the next video. Chris Crane Lanta Mentorship, and write something in the comments below. Let me know that you're a faithful member of the cult. Financial cult, I mean. debt free culture.